Good afternoon, everyone. Thank you so much for joining us for our last Power Play Tuesday of February. We have a really awesome presentation for you today, one that has a topic that's important for every investor, but especially commercial investors. But before we jump into our due diligence PowerPoint today, I'm going to briefly just go over a couple of announcements and some of the upcoming events that we have. So this will be our class today with D.L. Campbell. But before we jump into that, our first announcement, of course, all of our education is strictly educational. We don't provide tax, legal, or investment structuring advice. We can't endorse any products, so that's why our due diligence is extremely important. But all the classes that we have here, just like this one, are for educational purposes. We do encourage you to, of course, always do your due diligence when doing new investments. But we love putting on education for you guys. So just like this Power Play Tuesday that we have, we also do a 12 o'clock webinar every Saturday, our self-directed IRA Saturday class. And that one's really great as well, kind of the similar format. But maybe if you're too busy during the week, we'd love to have you join us on the weekend there. If you're looking for maybe, not just, sitting on your couch, getting that education, you really want more of that networking. You want to come out, you want to meet people, maybe get some free food and free drinks as well. Come out to our SDIRA socials. So we have these in all of the cities, quarterly, Dallas, Austin, and Houston. And they're really, really fun educational events, but they also have that networking aspect as well. You can do deal pitching if you have a deal or a service at the end of the presentation. And a lot of these are panel events. So we bring in quite a few guest speakers. We theme them, make them a little bit fun. But these are really, really great events. So I encourage you to check them in your city by going to our website, and we will get you registered. Those are all free. If you do miss any of the classes, you can always go back and watch them on our YouTube page. All the webinars that we do Tuesdays and Saturdays are there. And additionally, if you want to join us every fourth Wednesday, we will be doing national networking. So if you can't make it out to the quarterly events that are here in Texas, come network with us on Zoom. We have people all over the US come onto there and do deals and meet people. So it's a great way to kind of maybe get out of your local network. But if you do ever have any questions about any of the events that I shared, any of our educational material, or you want to have a consultation with an IRA specialist to maybe get started or even just learn more, scan this QR code. It'll take you directly to our page where you can schedule a consultation on a time that works for you. So we are starting our two-step promotion. If you want to open up an account from now all the way until the end of March, we're running a really awesome, what we call the two-step promo. So what does that mean? Step one, that's going to be opening up your Quest account. But step two, if you fund your account, within this promotional time frame, we are going to give you a $125 account credit. So that actually takes care completely of your first transaction fee. So it's a really, really great deal. We encourage you to scan that QR code, this one right here, go ahead and grab it, 1, 2, 3, and ask us about this. Scan this QR code and it'll take you directly to the account application where you can look that over. But we would love to talk to you about that and share the benefits of, self-directed IRAs with you. Maybe you are a younger investor and even just an older investor that may want to get some of those tips. We are hosting a really fun webinar that is going to feature a panel of millennial investors. So kind of sharing what they learned, how they were able to get started investing, maybe how to utilize small accounts, getting past the fear of getting started. These are going to be tips and tools for not just millennial investors, but we want to highlight them, and show that, these investors are movers and shakers as well. So if you want to get registered for that, it's going to be an extended self-directed IRA Saturday, as you can see here. So it'll be from 12 to 3. But again, this one's free. And I'm actually really excited for this one. I'll be helping moderate, so hope to see you there. And I'm going to keep running through them. Sorry, I know that there's a lot here, but we have a lot of really fun events coming up, so we want to share them all with you. But like I was mentioning, those socials, the ones that we have upcoming for May are going to be veterans themed. So we're going to be giving back, doing a little bit of a charity event, as well as that educational networking. So this panel is going to feature veterans turned investors. And although, yes, the speakers will be veterans, this will be for everybody because it's really all about how do you make that transition from, maybe your day-to-day job or, not a full-time investor to becoming a full-time investor. What if you're just looking to do all of that? So they're going to share their information with you. And then we'll also have Wounded Warriors out to help with our charity event too. Austin's will be May, Houston's will be May 7th, May 2nd, and then Houston's will be May 7th, Dallas's will be May 14th. And of course, like I mentioned, all these events are free. You can register here. The only event that you may see here at Quest that's not free, and for good reason, is going to be our Quest Expo. And I saved the best for last because this is literally one of the most incredible events that I think Quest has put on ever. Our Quest Expo is a 3-day huge alternative investing conference where you're going to learn everything under the sun about alternative investing. We'll talk about multifamily. We'll talk about due diligence. We'll talk about single family. We'll talk about how to prepare and build wealth for your retirement. All these different aspects of alternative real estate investing. Over 35 speakers, over 85 vendors. And the really cool thing is there's probably going to be around 1,000 people there. So the opportunities for networking are incredible. Even if you're, I don't want to use a self-directed IRA, come out and learn. There's going to be real estate education for all the types of investors, even if you're not just using a self-directed IRA. So the tickets for that are around $450, but scan this QR code. I'll also put my link in here as well. I promise you, this is one of the most incredible events that you will get so much value out of, and I would love to talk to you about it more. And stay tuned because our agenda is coming in the next week or so. Alrighty, so there we go. That is my little bit of education for you guys. I'm going to go ahead and bring up DL Campbell to the stage, and I'll bring up her PowerPoint in just a second as well. But she's going to talk to us about the importance of due diligence. When you're getting into these deals, you want to make sure that you're protecting yourself and protecting your assets, right? So she's going to share this information with us. We also have a really helpful handout that we can share with you guys as well. So without further ado, I'll go ahead and bring you up, share a little bit about yourself, and then I'll let you take it away.
Wow, Sarah, that is so awesome. I'm going to come to all of these events. I'm going to sign up for everything.
We would love that. That's great.
Okay. Yeah, I love learning. So that's why we're here. I'm DL Campbell. I'm an engineer, investor, and I have 19 years of commercial real estate experience, almost 20 years. My first property was 16 units. So that's how I got started way back when. I forced 80% vacancy and did the rehab and doubled the value in the first year. So that was my introduction to commercial real estate, but not without a good bit of education because I was an engineer. And so I had different nomenclature and different business language that we used in engineering. I can do accounting at a CPA level. And so this real estate, these other alternative investments, they're using different language than what we may be used to. So I'm going to try not to use a lot of commercial language. I'm going to try not to use abbreviations because I really do think it's great for you to just learn wherever you are on your path. And the purpose for this education is to give you a chance to learn how to do that thing called due diligence, because it's a thing. It's comes before evaluating any kind of offering, and it's a part of the process that we need to take 20 minutes and look at. So, Sarah, let me know how much time we want to spend on the due diligence, and let me know when you want me to wrap up in about 5 minutes. We can just fit your schedule. And like Sarah said, we do want to give you a gift It's a free one-page takeaway. So you don't have to remember everything. It's great to take notes and cement that in. But I do want to let you know that Quest is going to be able to share a one-page due diligence document with you that'll cover a lot of these steps. So let's get started. Active versus passive investing. So one of the things that we need to identify is to say, hey, am I an active investor where I'm a deal doer? You still can't use your IRA for your own project, by the way. So say I'm a deal doer. Let's start with that. I'm running the roads. I'm making the phone calls. I'm searching the internet for deals. I'm working with the brokers, working with the sellers, getting them under contract and doing the property due diligence, et cetera, et cetera, et cetera. That's a full-time job. So some of us are that way. You still cannot use your IRA or 401k to invest in your own projects. And the reason for that is the IRS says that you need to have a custodian like Quest Trust to watch over the transaction and make sure you're following the IRS regulations in order that you can defer that tax. So if you haven't paid tax on your 401k yet, you still do owe that tax. That's your tax burden. That's what an accountant would say. That's your tax burden. But what we're doing is we have a great tax law that says we can defer that tax so we don't have to pay it. You can defer tax on the principal that you're investing into a project. You can defer tax on the distribution that you're getting back as well. So that's a fabulous way to reduce your tax liability by using your custodian, just like Quest. And we have about 13 or 14 Quest Trust common clients where we're making distributions every month. So we know that Quest is great on the front end. You know, not only are they friendly and helpful and running around to serve you, but they also have a lot of good education because it's a bit complicated, isn't it? So I love working with Quest. We're at an arm's length transaction with them, but we work closely to make sure that the client is taken care of. So that's an active investor, and you want to be sure and keep deferring your tax liability so that you can see more of your money. Now, the second type of investor is passive. Many are passive investors. They or a doctor or a salesperson, a highly paid professional, and they're time starved. They don't have time to go out and take on an entire new job. They want to work with a team. We have 400 years of commercial and construction experience. You want to make sure you have that great team that you are working with. You have to vet your team. And we'll talk about that along the way. Advantages of passive investing into commercial real estate. Well, commercial multifamily is sometimes what they call it, or soft commercial. We focus on this because everybody needs a place to live. It's not actually my favorite asset class, but everybody needs a place to live. And like we saw in the stress test pandemic, we need to focus on those asset classes that are recession proof. We need to focus our time and money on recession-proof asset classes. So passive commercial multifamily investing is more than half as risky as having your funds in the stock market. That's a big deal. If you can reduce your risk by 50%, then your risk mitigation or your risk tolerance is satisfied by 50% of that. And many of us, if we're investors in our 40s or 30s, but primarily in the 50s, 60s, 70s, if you're an investor like that, your risk tolerance is lower because you don't have the time to reproduce that income. So we have to be careful about that. Number two, commercial multifamily is less risky than single family. And the reason for that is just like a single asset, a single tenant asset, you're either 100% full or 100% vacant. So I would rather have multi units and be able to diversify, because the banks know that the owners cannot make that mortgage. The property has to be a good enough deal to pay its own bills. If a hard money lender will lend you money on a deal, it's a good deal. It's a good indicator. If they won't, then you want to pass on that. And let's take a moment and think about the market. This, I want you to resonate with a normal market. I love this market. A couple years ago, interest rates were way too low, and a lot of deals were getting done that shouldn't have gotten done. Death happens in the middle of a deal. So now I love the market because it's a lot more honest. You're going to have to evaluate about 50 deals to find a good one. You'll have to evaluate about 100 deals to find a stellar one. That is a normal market, folks. Let's resonate with that. I know that interest rates have been high. We have 20 lenders that we've told no on construction and debt financing. We've told the lenders no. And I've been saying that, hey, I think around June, the 1st of June, we'll see those interest rates drop significantly. And it happened. It happened 1 quarter early. I'm an engineer investor, right? So I'm saying this is the worst case scenario. And here we've seen those interest rates come down. So we're going to contract. It's awesome. Not that you could time the market, but you can say, okay, you're going to have a lot of sellers who didn't sell during that time, and a lot of home buyers that didn't buy during that time because interest rates were too high. That's a little bit of a market timing, but mostly you really can't time the market. You just have to get a good team and a good deal. So what questions should we be asking? If I'm a passive investor, I want to know about the company and partner background. Let's be asking a lot of good questions. Let's be going to their website and checking out who they're partnering with. Let's be looking at their track record. For instance, we have a recession-proof property type. It's Class A luxury, multifamily. Everybody needs a place to live, but we want those tenants to pay every month. So our tenant type is 30-something, building their career, and they just pay the rent. Now, a little background, the Supreme Court told the CDC that what they did with that rent moratorium was unlawful. It was unlawful to say, hey, landlords, you're going to have to wait a year to get your rent. Nobody knew. And so it's great that the Supreme Court did that. Now, Congress could still do that again. So we have to watch out for our governing body and how that's affecting our business. We vote to change things, and we select an asset class that is recession proof. I'm excited. In fact, I'm excited. I'm getting chills right now, obviously, because it's such an exciting time for the market with these interest rates having come back down. But also, we passed the stress test of the macroeconomic and microeconomic pandemic. It showed us what the good asset classes were. It showed us where to focus our time and money. So it ended up to be a blessing in disguise. So we need to be looking at what are the advantages for our partners? Is the deal a win-win deal? Who's managing the property? What kind of fees are associated with this transaction? We don't take fees because we're not syndicators, we're owners. So what kind of fees do I have to pay to get into this transaction? And Quest Trust is one of the lowest fees in custodians. It's great. Can you access the property? Can you drive by it? All kinds of great questions that you need to be asking, because It's your time, it's your money. So, what are some of the mistakes that many passive investor owners make? Not understanding the deal structure. So, we're going to request that you spend time on your due diligence. We're going to say, hey, take your hand off your wallet. I don't have anything to sell you today. We're just going to continue your due diligence. That's it. We think that's important. And then all of a sudden you'll go, okay, I'm ready. We'll go, okay, how can we help? So our paradigm is a little bit different. We're going to continue due diligence. We have Investor Club portal, many transactions, many deals, assets have Investor Club portals where you're going to want to pull all of the due diligence. What is the city saying about this property? What kind of approvals has the team gotten? What are the resumes of the people working on the property? How are the distributions to be made? What are the caps on distributions? And I know this is a lot, guys, but take the time when you get the replay and just re-listen to it. You can't time the market. You just have to deal with the type of market that it is. And this is a great market to get used to it. I love it. The market is telling the truth about deals. Now, one of the things that we do want to be aware of, we do want your CPA and your attorney or counsel to be looking at the documents that you're going to sign. The PPM is the private placement memorandum, and that is basically to warn you about all the things that could ever possibly go wrong in a deal. That's what that's for. But remember, a CFP, a certified financial planner, is not going to get paid on the transaction. So we have to watch their loyalty. And it's your deal. Your CPA and your attorney are there to protect you, and you're probably going to get a no more often than not. Because if they say no and you don't do it, you're protected. But if they say yes and you do it, you'll say, hey, Mr. Attorney, you said this deal was okay, but literally all they can do is look at the contract and tell you if it's a fair deal or not. So this is on us to do our due diligence and make a decision that matches your investment goals. Because the risk of not investing is letting inflation take over. The money could sit in the bank at 0%, or they could charge you for letting it sit in the bank. There are also risks of not investing, right? We recommend Quest IRA, and they've approved our agreement about 14 times. So you can come in with cash, a 401k or 201k, actually, the way the market is, IRA, and they can help you with all of those excellent tax reduction strategies, because really they're the experts. They have the Roth IRA, they have the self-directed IRA. It will take Quest about 1 week to translate whatever in financial vehicle or investment vehicle you're bringing them. And then in another week, they will have taken the ownership documents through their legal counsel, and it takes about 2 weeks in total to get a wire from Quest, and they will help you out with all of that. So let's understand the typical value add strategy. Looks like we're doing well on time. And typical value add strategy, that's what I started with my 16 unit. It was in East Dallas, lovely F crime rate area. So I kicked out all the problems, and I forced 80% vacancy because I had discretionary income as an engineer. I did the rehab with the guys, and I re-tenanted that property with little working families, small working families, every kind of demographic that you can think of. It just kind of naturally grew that way. It was very nice. So instead of finding, I'm going to say this, instead of finding needles on the property and beer cans, then we started finding toys all over the property. That's a great paradigm shift. But if you're working with a C-class or D-class property, that is the honest truth, that that's what's happening on those properties. And it was nice to see those kids come home from school and be able to focus on their homework, focus on getting a snack, and then being able to play outside. So we had sounds that were different as well. We had sounds of children. Now, right now, it's not a great time to do that value add structure because many deals were bought wrong with that interest rate that was too low. In fact, there's a bad word that is going around on those deals, and that's called a capital call. A capital call is when somebody has invested and the sponsorship team gets in trouble and says, hey, Mr. and Mrs. Investor, you need to come in with more capital or your position will get diluted. So we've never had a capital call. In fact, I've never seen capital calls for a refinance in the 20 years that I've been working in commercial. We want to avoid that. But the reality is that there are those kind of deals. And that's why we're doing our due diligence is to put your hand on your wallet and say, next, this is not a good deal for me. If it's a C-class renovation or a D-class renovation, those profit margins are going to be very low. Here's what we need to look for when we're investing in commercial. We want to invest in a property that has room for appreciation. Now, what happened with those interest rates? Prices were doubly as expensive, and the syndicators were bidding against each other. So there's no room for appreciation. It's going to depreciate. The other thing that we look for is to be able to force cash flow. We want to have those two legs to stand on so we're safe. Either leg, we can hobble, it'll be safe. So there was room for cash flow to be improved, and that's okay. But now we see the C-class and some of the B-class rents be minimized. There's not a lot of profit margin, and so there's not a lot of room for distributions there. So this is an important distinction. It's due diligence. What we want is we want room to force cash flow and force appreciation. And that's why on our properties, we've started with land. This is a picture of our sister property, 22 North in Northwest Austin. And it's on Baghdad, 240 Class A luxury multifamily units built on 14 acres, tuck under garages, beautiful landscaping, the 30-something colors that pop. So all of the pictures in this presentation are actually from our sister property, 22 North. And it sold in 2021, December, for a profit of $22 million. Nice, right? That was a great outcome. So let's talk about some of those benefits of forcing value on the dirt. It's a lot of work. You have to get entitled. You have to run the construction. And but it's also where you get the most value, the most increase in rents, and the most appreciation is by forcing value on the land. Beautiful asset. It's on Baghdad. If you're in Austin, I welcome you to drive by, walk the property, and take a look at that asset. Another picture from 22 North. I love this picture. It's kind of under the umbrella, kind of a sneak peek of the common area. But again, colors that pop and that are very nice, that are going to attract that 30-something tenant that always pays their rent. Financials. We want to look at a year one stabilized budget. We want to look at that. We want to make sure that the expenses are high enough, that the owner is not underestimating those expenses. We want to look at a 7-year pro forma. Now, on our 7-year pro forma, we have ultra conservative bank underwriting. And so the banks love us. I know that Dallas has a 2 or 3% vacancy rate, and it has for the 15 years I've lived in Dallas. But we actually put the bank required 7% vacancy rate into that pro forma. The bank is going to require that. Another risk mitigation is the DCR. Okay, there's an abbreviation, debt coverage ratio. So what the bank is looking for is a 1.2 to a 1.3 DCR, debt coverage ratio. And all that is it's saying that, hey, for every dollar that we spend on this property, we want to see $1.20 or $1.30 come in. For every dollar that we spend on expenses, we want to see $1.20 or $1.30 coming in. And that's a debt coverage ratio. Cool, huh? So we also put a 5% cap rate, a capitalization rate into our pro forma. What's that? Well, some people buy at a cap rate. I recommend we don't buy on a cap rate because it can be manipulated. That data can be manipulated. But it is somewhat of an indicator. So a Class A luxury 5-star multifamily is easily a 3.5 to 4 capitalization rate. Well, we have underestimated our value because we don't want to overvalue it. I'm an engineer investor, right? We're not going to blue sky these things. We're not going to blue sky these things. So a cap rate that is lower is better. It's an opposite paradigm. So to be conservative on that capitalization rate, we have estimated a 5 cap, not a 3.5 or 4 cap, which is better and is actual. But we want to not overvalue our property, and our 7-year pro forma has a 5% capitalization rate. So we're just not going to overvalue our property. If you would like to do some homework, you're welcome to do that. If you're a sophisticated investor or you are an accredited investor, then you're welcome to take a picture of that QR code and use this case study, the Prestige, to do some homework after this training. I think we went over that. We talked about the private placement memorandum, the subscription agreement, the financial review, and then do a deep dive. Do a deep dive with the property or with the asset and get to know them and let them get to know you too. Another picture of our beautiful 22 North. This is the common area with the island in the background, but we've got those 30-something beautiful popping colors. Maybe not my style, but those 30-somethings, this is what they like. And what is nice about this tenant type is that they're not going to leave after a year or a year and a half. Our tenants will stay 5 or 6 years. So it's actually a great cost savings if you don't have to turn that unit. That's another advantage of this tenant type that we're sticking with. But I think that's just a beautiful job that these designers did and the architect did on 22 North. More pictures of 22 North. Now, we closed the Prestige in June of 2023. So we're using the pictures from 22 North because we're taking a lot of that strategy and a lot of those ideas into our current property. We've right-sized some of the floor plans. We have streamlined the amenity building. Beautiful. I'm so excited about the pool area and amenity building in our property. We're doing some pretty cool things, guys. We are looking at those amenities with our general contractor owner's rep, who also does hotels, and they're bringing the big capital stack out of $100 million fund. Nice. The advantage is that they are thinking along the same lines we are. So their properties are like this and like this. They're gorgeous properties. We don't have to have a lot of discussion about our tenant type and the amenities that we're going to have, because they're on the same page. They want that recession-proof hotel, and we want that recession-proof multifamily, because they always pay their rent. We're looking at some pretty cool ideas, like Instagrammable moments for these influencers, and having a sound room, a small sound room with an affordable sound system where they can do some Instagrammable moments, having different parts of the property with Instagrammable backdrops, concierge services in the amenity building. I love this for the professional. Drop off your laundry and get it the next day in the locker in the mailroom inside the amenity building, 24-hour access, large islands to handle your mail, a bulletin board system, electronic bulletin board system to know that you have a package in a locker, drop off your dry cleaning and wash and fold, grocery delivery service right into your apartment, so the lettuce can get into your refrigerator if you want, or dry goods into your locker. So we're also going to have a very cool little shop for snacks. If you have a popcorn emergency at the end of your day and the office is still open, you can go to the concession and you can get a Diet Coke and a popcorn if you have that popcorn emergency. So you can tell I'm very excited. I'm very excited about this property. So as we wrap up, let's look at what is an accredited investor status. What is an accredited investor status versus a sophisticated investor status? So if you're a sophisticated investor, you're doing trainings like this. It's hard. You're busy, you've carved out time, but look at the training that you're getting from somebody who has nearly 20 years of commercial real estate experience and a team that has 400 years of commercial and construction. I just got off my civil meeting with my architect, landscape engineer, developer, services, pre-construction project manager. Very, very good meeting. Let's look at accredited investor status. If you're sophisticated, you're getting these kinds of trainings, and then you're a sophisticated investor. An accredited investor is a single person making $200,000 a year for the past 2 years, and with the expectation that I'm going to be making the same in the next year. What's an accredited investor as a couple? Well, a couple has made $300,000 for the past 2 years with the same expectation of reaching the same next year. Or you have $1 million in assets. That could be a number of different assets, but it has to exclude your primary residence. That's an accredited investor. You could be a person with a current SEC license, an SEC law license, Series 7, 65, or 82. You could own a business that has over $5 million in assets, excluding your primary residence. So that's what the SEC says is an accredited investor status versus a sophisticated investor status. And now the last thing that I want you to know is about what the SEC's goal is. If you want to find out more and you are a sophisticated or an accredited investor, or if you don't know, click on this link and you'll be getting an email every once in a while. So the SEC has two goals. They want to protect you. That's why you have that PPM, that private placement memorandum, with all the things that could go wrong in an investment. But the second thing that they want to do is coupled. They do want to present good deals. They want to have good providers and good owners presenting good deals. So they really have a two-pronged approach. They want to protect you and they want to provide good deals. Now, if you're working with your IRA, then you want to be able to call Quest, ask them questions about how to set up your IRA and put that IRA to work and be a hedge against inflation. You want to have collateral in the property that you're getting into, and you want Quest's help for setting up that Roth or the self-directed IRA and putting it to work in a property where you're going to be getting monthly distributions, parts of the rent, part of the sale. You want to be involved in all of those different profit events. So that's what I have for you today for commercial real estate due diligence. It is on you, but we're here to help.
I love that. That was great. And I love how you kind of wrapped it up. It's on you, but we're here to help. And I think that's, same concept over here at Quest. We always love just, providing that education. And I think this is really great. We do have a couple of questions. I'm going to go ahead and pull them up. Okay, there we go. We have our moderator helping as well. I understand there are tax benefits, depreciation, cost segregation. How are those applicable to passive investments from IRA accounts?
Well, that's a great question. With a commercial property, you have that property depreciating over the life of 27 and a half years. And so that's depreciation expense. The roof is wearing out, the parking lot, the HVAC is wearing out. And so from an accounting standpoint, we force that depreciation into the first couple of years. So we share that with our investors through what is called a cost segregation study. So this is a very advanced technique, Arturo, really great. What that does is that allows us to share that depreciation expense to people who can use it against their W-2 income or against their passive income. And you need to check with your CPA on how that applies to your own individual financial situation. It's kind of an IRA question, but it's more of a CPA question based on your own financial position.
Okay, we have another question here. How do we find our deals, B or C class?
Okay, so here's a deal doer. Steve is a deal doer, and he probably has an IRA that he wants to invest in somebody else's deal. So now I'm a deal finder as well, Steve. So what I did to find my deals is I got all over the internet, and I also drove the miles. So I'm driving these neighborhoods looking for things. And what I did was I found a small sign. It was off market, which is great. I also looked in Rowlett at a property that I found, and I did the same. I looked all over the internet. I looked on LoopNet. I looked at fsbo.com, for salebyowner.com. I looked on the MLS, realtor.com. And I just looked everywhere for deals because it has been a real seller's market. And it's a challenge for deal doers because there hasn't been a lot for sale. Now with the interest rates having been so high, sellers weren't selling. Sellers haven't been selling. And I think we're going to see a couple months of sellers continuing not to sell just because they're cash flowing right now as a strategy. So I would say put in the work, do the due diligence, also couple with a team that has more experience than you do. so that you can be learning what to do with those deals when you find them. Some people will go to attorneys, divorce attorneys, probate attorneys to find deals as well. Now, we have a YouTube channel, The Prestige, where we share our experience of what we're doing on our properties, and it's free education too. So I would recommend all those things.
Awesome. Thank you for that. Arturo asked a follow-up question. He says, this one's for you. Can the preferred rate of return or return rate be negotiated in place of maybe some tax benefits?
That's a great point. It's a flexible decision, isn't it? Because it's if you're working with the owner, then they can make that decision. Um, and I think that it would just be between you and the owner. Um, if you're working with a syndicator, you're probably not going to have that access as much as working with an owner. But from our standpoint, that is definitely a doable situation.
Awesome. Good answer there. We're getting a lot of questions coming in. I'm loving this. So Stephen has a big question here. So given that some developers developed multifamily units doing low rates and inflated valuations, what things should I be mindful of in acquiring such properties or assuming another developer's loan?
Mm-hmm. And that's one of the points that is so important, and one of the reasons that we're doing the commercial due diligence, because the way that the syndicators have messed up the market, it really breaks my heart. And I think it's important for people to be able to have these tools to do your due diligence. You're going to be seeing deals that they're not going to tell you. You're going to have to, if you're looking for a deal, you want to be asking that mom and pop owner, hey, I want your trailing 12, your T12 audited statements, or I want your last 12 months bank statements, because they're going to be blue skying a lot of things. They're going to be showing expenses that are too low, so it's looking like they have a great profit margin, but they don't. They're going to be showing all kinds of income because there's certain things that a bank will not allow in your pro forma when you're looking at multifamily. Some of the profit centers you can include, and some of them you can't. So here again, Stephen, this comes back to this is a normal market. It's an honest market. It's telling the truth about these mediocre deals and these teams that also have maybe 10 co-general partners with 2 or 3 years of experience. That's another key indicator that you have to look for, is the team. So I would say look at 50 deals. Be prepared to say no to 50 deals to find a good one. And you might have to evaluate 100 deals to find a stellar one.
Yeah, it's all about putting in that work. And I love that you answered all that. Does anybody else have any questions? I do want to make sure that if you have any questions, be sure to post them here in the comments so I can pull those up. Loving all the questions that we've had so far. And I also want to mention we have a handout as well that we talked about at the very beginning of the presentation. We'll be sending you guys that as registered RSVPs for this class. But share that with your networks if you find that useful. I looked it over and I think it's really, really helpful. We're going to go ahead and give that to you, like we mentioned, after the class. Doesn't look like we're having any more questions right now. Let's see, I'll give maybe a couple more minutes. But do you have any just last minute tips that you'd like to share before we wrap up the class today?
Did you want to show the handout, or do you want to have them?
Yeah, let's go ahead and do it. I went ahead and pulled it up. Here it is. It's a 1-2 pager. If you want to kind of give a little bit of information, feel free.
Yes. So here we're going to go back through these points, and we're going to just bullet point them so that is a handout that you can print out and you can take with you when you're analyzing deals. go to our YouTube channel for more information, The Prestige, and look at how to evaluate locations, how to evaluate owners versus syndicators, how to evaluate traffic counts or utilities available in the area. We're serving 3 job markets. So with a workforce housing property, the tenants are probably not going to drive more than 5 or 10 minutes to work. Whereas with a Class A luxury property, of course we drive 30 miles. Of course we do. So we have some great information on that. So the second page is, and these are all pictures of our former property, 22 North. So the second page is a way you can find out more. You've got that QR code to opt in and find out more. Get an email, once a day for 7 days. We're not going to email blast you, but it'll be more education on what kind of questions to ask your sponsors, how to vet your deals, those kind of things.
Awesome. I'm going to go ahead and take this down and just bring this back up one more time because we did have somebody that asked, how can I get in contact with you? So if anybody else is wondering that information as well, you can get it right here. I'm sure this QR code deal, that may probably take them to the website as well. But it looks like we've got an email, a phone number, and the YouTube page. So that's how you can get in contact with
Yes. And then also, if you want to go right to the website, it's invest.theprestige@mayhill.com, invest.theprestige@mayhill.com. If you're not QR savvy like me, then I'll just go to the website.
Okay, I went ahead and typed it in the comments. Let me make sure I got it right. Is it this invest.theprestige?
Prestige@mayhill.com.
At mayhill.com. Okay.
Mm-hmm.
Okay.
Invest.theprestige@mayhill.com.
Invest.theprestige@mayhill.com. There we go. Boop. Okay, guys.
Nope. That's the thing with computers. If we have one digit wrong, then, and it's kind of little, Sarah, so I apologize for that, but it's invest.theprestige@mayhill spelled out.com.
I see it here. If you want, guys, it's underneath this QR code right here, invest.theprestige@mayhill.com. You can grab it.
Yeah, those are all the digits that I would get wrong, probably.
You say at, and I'm like, at sign. Okay. But yeah, no worries. Okay, cool.
Well, I just want to thank you, Sarah. It's been a pleasure working with you all, and I look forward to working with you more. And we're going to present, I think, when is it? Saturday, April 20th.
Yes, we'll have a follow-up class.
That's our next training. So thank you so much.
Yes, thank you again, guys. DL, for joining us. It was a great class. Of course, to everybody who participated. And we will see you hopefully this Saturday for Self-Directed IRA Saturday. Thank you so much.